What market factors should investors be focusing on in 2026? I'm joined by none other than Ann Sonders herself to learn more. Ann, thank you so much for joining me.
Good to be here. Welcome to Impact.
Oh, thank you. I look forward to Impact every year, and funny enough, it's in my backyard this year, which is
That's
quite nice to be right down the road.
my backyard, but that's okay.
You guys, certainly you know somebody here at Schwab. Maybe you could talk to them about that. But I've been very much looking forward to this conversation because a lot has happened in 2025, as we know. Because look, investors have had to navigate a lot between tariffs and now a lengthy government shutdown, data voids, and honestly, this whole evolving monetary policy environment. So, what risks are you monitoring heading into 2026?
Multiple risks. I think that there's obviously a decent amount of frothy sentiment, some frothy / risky behavior happening in certain pockets of the market. That's always a little bit of a concern. Valuations are stretched. Valuations are a terrible market timing tool. They're more a temperature taker than they are a timing gauge. But I think that has brought some of the recent angst into the market. Obvious concerns about the build out of AI, and is it akin to the late 1990s? Is this a bubble that's imminently set to burst? And then helping our clients, obviously, in how to navigate through those risks. You mentioned Fed policy. I also think a risk to consider as we head into next year is actually a little bit of a continuation of a risk that exists now, or a bit of a pickle, I should say, that the Fed is in, because the Fed is unique among central banks globally in that they operate with a dual mandate. And arguably, the two sides of their mandate are sending different messages. So to mix metaphors, they're sort of in a pickle between a rock and a hard place. And that could improve, but it could get worse, where inflation either reaccelerates or stays sticky on the high side, sending one message to the Fed, yet further deterioration and the labor market side would send a very different message to the Fed. So I actually think, particularly given the government shutdown and the data desert we're in, what seems to be a bias toward a bit of a pause moment for the Fed, I think that makes a lot of sense.
And under the hood, U.S. stock market leadership has been concentrated in a few mega cap names, right? So do you expect that concentration to broaden next year?
Hopefully, I think that would be healthier for the market. But what could happen is, if we were to see a more serious corrective phase among some of those big mega cap leaders, that we might start to actually see some better breath under the surface. And to illustrate what that looks like, it wasn't all that long ago that we experienced it. It was 2022, the last bear market year. And the market had its first big, I'll use a technical term here, whoosh down in June. And at that time, the market was ugly and breadth was pretty ugly. But fast forward to what became the low in October. Part of the reason why we felt that looked like a healthier backdrop for a potential rebound was because even though at the index level, the S&P had taken out its June low and continued to sell through that, there was kind of this quiet, subtle breadth improvement under the surface. So you had kind of a retreat by the generals from the front line, but more of the soldiers moving to the front line. So that's not only something that we could see, I would say that's what to watch for. If what we saw on a day like yesterday, which was kind of ugly activity within the tech space and the AI space, that if that turns into something more protracted, it would have a deleterious impact on these cap-weighted indexes because they're so big. But watch what the rest of the market is doing. And that's where you might actually see kind of some stealthy improvement that might not be very noticeable for everybody focused on the market being these cap-weighted indexes. But those are I think it's always important to peel the onion back a few layers to get a full story of what, again, the air quotes, the market is doing.
Absolutely. And you actually often emphasize leveraging factors to inform investment decisions. So how could advisors and even investors benefit from taking this approach?
So I think this is becoming much more popular way to screen for ideas, to pick individual stocks, is to take a factor-based approach. So investing based on characteristics versus, say, the monolithic, it's always funny when I get, so do you like small caps? And I think, there's almost 2,000 stocks in the Russell 2000. That's not one monolithic thing. And that can even be applied to some degree at the sector level to say, I like this sector, I don't like this sector. There's always a wide array in terms of performance. And where you tend to find more consistency in performance is at the factor level, not at the sector level, not at the broad large cap versus small cap level. And so I think there's a lot more firms, including ours, that are doing much more work on factors and using them to create baskets and create thematic lists and offering screening tools for people to say, okay, even if it's in conjunction with, say, sector views. So you say, okay, we're recommending an overweight or an outperform, whatever terminology might be used, to technology, but then used additional factor screening. So what do I want to specifically look for? Well, I want to avoid some of the risks from an extreme valuation perspective. So have a value factor or two, but you don't want to sacrifice growth. So look for those growth factors, strength of balance sheet, high interest coverage. So getting more to the heart of why companies do well or don't do well is that characteristic-based investing. And I think that will continue to grow in popularity.
And I want to go a little bit deeper on that because in your opinion then, what are some of the most important factors to focus on?
I think, I've been in this business almost 40 years, and there was an acronym that I think was probably most popular in the 1990s, which was GARP, growth at a reasonable price, where you took into consideration both the valuation side of the equation and the growth side of the equation, as opposed to more traditional, someone's just in the value bucket and someone's just in the growth bucket, blending them together. So the factors that I think are important now are a little bit GARPy. You don't want to sacrifice growth. So factors like positive earnings revisions, positive forward trajectory in earnings, but also reasonable valuations, be it on a PE basis or a price to book or price to sales, strength of balance sheet, especially in an environment if the Fed is in some sort of pause mode and we don't have that tailwind of lower rates. Look for companies that are not zombie companies. They have ample interest coverage. They can continue to pay interest on their debt. So those are some of the factors. The one other interesting thing about factors is that one of the most popular factors that people track and they talk about and they measure is the momentum factor. I think there's a misperception about what that factor is. The momentum factor isn't really a fundamental factor. It's more of a concept. But I think when people hear, momentum's doing well, they think high beta tech stocks, comm services stocks. When the momentum factor is working, all that means is stocks that have been working are continuing to work. You can have momentum, as we've had recently, in utility stocks. You can have momentum in the bond market. You can have momentum in really boring, dull consumer staple stocks. It just means that what has been working continues to work. And I think that sometimes trips investors up is not truly understanding the momentum factor. And another way to think about this is we touched on the fact that there are concerns about, is AI in a bubble, and does this harken back to the late 1990s? The last time momentum as a factor was as consistent a driver of performance was in the late 1990s. But the fundamental factor that was most closely aligned with that was negative earnings. So there was momentum as a factor was winning, but it was the negative earnings. So the momentum was in low quality areas.
Interesting.
So that's maybe a differentiation now because momentum has been a dominant factor, but a lot of the momentum has been in high quality stocks. So just understand when somebody talks about the momentum factor, it's a concept more than it is a fundamental.
Well, I think that's great advice and people should absolutely hone in on that. Liz Ann, this has been an absolute pleasure. Thank you so much for your insights and looking forward to having this conversation again in 2026.
I hope so too. Thanks.
For wealthmanagement.com, I'm Shannon Rosic.